welcome everybody, and thanks for joining us. And yeah, I'm just going to pray for us, and particularly, the heart of Christian Super is for you guys to just be able to live your life with financial health and understanding, and this is one part of it. So yeah, I just want to pray for everybody who's attending and listening later. So yeah, let's just pray. Yes, so Father, I just thank you for who you are. You're a generous God, and you love us, and you use technology and you use non-technology. I just ask for everyone who's listening to this, whether live or later, God, that you just show us what we need to know about our finances and free us up to live the life that you want us to live. I just ask for Gav as he speaks tonight, and everyone listening, and just for Gav to be able to answer our questions, for the technology to work. We just thank you for the internet. And yeah, just help us to all come to a place where we just feel built up from this session tonight. We just pray it all because of Jesus. Amen.
Amen. Thanks so much, Phil. Really appreciate you being on board this evening. No and feel free to chip in anytime if you stay for a little bit longer too.
Certainly will. Thanks, Gav.
Thank you, Phil. So welcome aboard if you've just joined us. My name is Gavin Martin. I'm from Cornerstone Wealth, and that was Phil Watson, the Digital Marketing Coordinator of Christian Super there. So thanks, Phil. Before we get started, it's important to note that the webinar this evening is advice of a general nature only, and please seek personal financial advice before making any decision. If you wanted our assistance in seeking personal financial advice, the way we go about that is to first have you prepare a brief questionnaire, to enable us to hit the ground running in what we call the discovery meeting, and that's where we try and understand your goals more fully, look at your current situation, then talk through the pros and cons of the range of options available to you. Now that meeting might be sufficient for you, or you might want to go to the next stage where we prepare and present to you written recommendations for your particular situation. We can also help you implement that advice and provide ongoing monitoring and review as well. So the first thing that, in terms of actions that you need to take, is firstly, particularly with the changes, you need to decide your 2017 concessional contribution amount, how much you want to contribute to super. Now, before we go into the details of that particular strategy, we'll just touch on what concessional contributions are. So they're pre-tax contributions, and they include the 9.5% superannuation guarantee your employer puts in, but your employer might also put in additional contributions as well over and above the 9.5%. You might be salary sacrificing, so not taking your salary as money into your bank account, but direct it from your employer into your superannuation account. That's salary sacrifice. And in some cases, if you satisfy the criteria, you can also make what we call personal deductible contributions. So they're what we call concessional contributions, and they're called concessional because they're taxed at 15% rather than possibly a higher marginal tax rate that you might pay if you receive the money in your own name. So the action that you may consider before the end of the financial year is due to the annual limit, the concessional contribution limit reducing in next financial year to $25,000 per annum. You may wish to consider utilising the current year limits. So they're currently based on your age. So if you're under 50 years of age, it's a $30,000 annual contribution limit, and for somebody over 50 it's a $35,000 contribution limit. So that's for this financial year. So there's a window of opportunity to utilise those limits. And to give you an example of the benefit of those, we'll just take an example of someone who's on $105,000. That means that their employer is putting in $10,000. That's 9.5% of the $105,000 is $10,000. If you're over 50 and your contribution limit is $35,000, then there's an available threshold of $25,000. So if you salary sacrifice $25,000 of your income, so you forgave the income, so you didn't take it as salary paid into your bank account, but got your employer to direct it to your super fund, there's a potential tax saving of over $6,000 between now and the end of the financial year. So well worth considering. Now with salary sacrifice, you need to do it into the future. So if you're on $100,000, you've probably got between April and June's pay to salary sacrifice, which is about $25,000, which is about on that threshold. So if you salary sacrifice 100% of your income from now, you potentially could save $6,000 in tax. Now you need to make sure that that's the right strategy for you, that you have enough cash flow to do so. There are strategies that we can consider to get access to cash if that's an issue, but it is well worth considering to save that $6,000. You do need to also factor in whether how long it will be until you get access to the money. So those people that are those of you who are in the 25 to 35 type age bracket, you really need to think about, do I put the money against my mortgage or do I save some tax? And you've really got to weigh those two things up. But those that are closer to your preservation age, so 55 to 60 years of age then and above, then it's well worth considering, even if you do have a small mortgage. Just to give you an indication of the benefits for somebody on $55,000, your employer in that instance would be contributing $5,000 to your account. If you're over 50, then there's a $35,000 contribution limit this year. So you could salary sacrifice $30,000 and save just under $6,000. Now a little bit different to the previous scenario. When you're on $105,000, you may only have about $15,000 of your income remaining for the rest of the financial year. So you may only be able to put in $15,000 this financial year, and which would mean you'd be saving probably half of that in tax, so around $3,000 in tax rather than the nearly $6,000 in tax. So that's a key decision to make, because the threshold is changing from 30 to or 35 down to 25 next financial year, and you'll not be able to put as much into super at these concessional rates into the future. So that's one question. Decide what your level of concessional contributions amount should be. You also need to consider what your non-concessional contribution amount should be, because next financial year it's reducing. The threshold is reducing to $100,000 a year. And I know this sounds like a lot, and many of you who are earning around $36,000 or less might be thinking that you'll take advantage of the government co-contribution, which is putting $1,000 into your account to get a co-contribution from the government of $500. And this is the type of contributions we're talking about. Non-concessional means that it's after-tax money that you've got in your bank account and you're putting that into super. There's no tax payable on the way in, and the threshold is going to change to $100,000 next financial year. But if you are under 65, you can actually bring forward 2 future year contribution limits to put $300,000 in one financial year. You need to be under 65 for you to do that. But the window of opportunity for some is that you may be able to take advantage of the old contribution limit. So currently this financial year you can put in up to $180,000, and if you are under 65 you can bring forward 2 future years contributions at the old rate of $180,000. So you could actually put in, an individual can put in up to $540,000. Now that's assuming that you haven't breached your bring forward rules in prior financial years. But you might be thinking, well, I've only got $350,000 in my super account, so I haven't got surplus money to put in. Well, there are strategies, if that is your situation, where we often consider cashing out your super balance, putting it into your bank account, and then contributing it back into your super to facilitate estate planning and saving your beneficiaries tax, because often your super account is made up of taxed components which are taxed at 17% if they go to financial non-dependence. So it's a way that you can utilize these thresholds and save your kids, your adult kids for example, 17% death benefits tax. So that's the non-concessional contribution limit. So think about how much you want to put in. If you're on a low income, then you may be just thinking about $1,000 for the government co-contribution. If you've sold assets or thinking about or received an inheritance or wanting to complete that cash out recontribution, then you might want to utilise these types of thresholds. You also may want to consider these contribution limits if your super balance is getting close to the new proposed threshold. So there's if your account is, if your super account, that includes both your superannuation account and your pension account, so accumulation and pension account, is over $1.6 million, then you can't put any more funds into super next financial year. But this financial year, you've still got these $540,000 limits without the $1.6 million rule applying. So that's just another reason why you might consider this window of opportunity to get funds into super. We've got a number of clients at the moment that we're working towards retirement, and to avoid having to worry about tenants and managing investment properties, we're liquidating investment properties and contributing the proceeds to super, so we're moving into the 0% tax environment of the pension phase of super, so under these limited window of opportunity to get funds into super. Relating to that, it's good to also decide when you want to sell assets, if that's something that you want to do. You know, often we come across people planning for retirement, and they're wanting to liquidate either shares that they're no longer wanting to manage, or investment properties that they're not keen to continue to manage longer term. And there are three key areas that the new super rules have made us really think about the strategy around. So if you're in this situation where you're either thinking of selling an investment property or another asset like shares that have got some capital gains associated with them, there are three factors that you need to consider, and one is your age. So if you're under 65, you can trigger the bring forward rule, which is those 540 limits in this financial year versus a $300,000 limit next financial year. So your age and your concessional contribution is one factor in thinking about the timing of selling of assets. The other factor is your current super balance. Is it close to or approaching the $1.6 million? And then the final one that might apply to more of you is the capital gains tax consideration. So this financial year, as I mentioned, you can reduce your capital gains tax liability on the sale of an asset. So that means if you've sold an asset for more than what you bought it for, you've potentially triggered a gain, which is taxed at your marginal tax rate. And you can use those concessional contribution limits to reduce your tax. There's higher limits available this financial year, lower limits available next financial year. But if you have a balance less than $500,000 in your super, you may be able to utilise what we call these catch-up provisions, where if your balance is less than $500,000, you might be able to save more tax by waiting until a few years into the future to sell an asset as well. So we weigh up these three areas. What's your age and how much can you get into super? What's your current balance? Is it close to 1.6 or is it under $500,000? And then it's a matter of, well, do you want to sell the asset or do you want to keep it? What's going to have the best longer term impact? And that helps us decide whether to sell an asset or not and get the funds into superannuation. Just to clarify how that catch-up rule works, it basically means that from the 18-19 financial year, if you don't utilise your full $25,000 contribution limit, you can utilise prior financial year's limits in later years. So for example, again, using the $105,000 income, $10,000 being put into super by your employer. So that's $10,000 put in by your employer. You've got a limit of $25,000 each year. And so there's an unused portion of $15,000, which could be utilised the next financial year. If, for example, we didn't work during 19, 20 and 2021 financial years, that unused limit of 25 would add to our 15 to bring it to 40, another 25 to 65. And then if we, for example, sold an asset in 2021-22 financial year, then we could actually claim a deduction, contribute $85,000 to super, and save tens of thousands in tax in doing so. So when selling assets, we're trying to weigh up all these factors: your age, your superannuation balance, and do we need to offset capital gains tax, and then which rules should we focus on? the higher contribution limits this year, or potentially even higher contribution limits using the catch-up rules over the next few years. Got a couple of questions coming through. So Craig's asked, if I voluntarily add $15,000 from a savings account to my super, is there tax on that sum? No, if you're just putting funds in as what we call a non-concessional contribution, then there's not tax payable. If it's a what we call a concessional contribution, then it's 15% tax deductible on those funds. Kerry asks, can you put $5,000 government contribution? Can you put in $5,000 government contribution? I think what you're saying there, Kerry, is with the $1,000 what we called co-contribution, is if you, rather than putting $1,000 in, you put $5,000 in, would you get more from the government? And the answer is no. The maximum benefit can be attained by putting in $1,000. If you put in, and that might get you $500 from the government, but if you put in $5,000 and you're fully eligible for the co-contribution, you're still only going to get $500 from the government. So putting in more doesn't really help. Janine is saying, I did not get the last page. Decide on 2017 non-concessional contribution amount. Who can I speak to about this? I'm 59 years of age and I need to retire in the near future. Yeah, that's not really sure. Maybe I can take that again, Janine. I'll come back to it maybe at the end of the session, and I'll try and explain that a little bit more fully. So Leanne asks, so then the catch-up on super payments must be in the same financial year as the sale of asset. Yes, that's right, Leanne. So if you're wanting to utilise these catch-up rules, what we're saying here is that if you've accumulated an unused portion, in this case we're in the 2021-22 financial year, we've actually got $65,000 plus $25,000 of contribution limit. That's $90,000 contribution limit, and then it's ideal to sell the asset in that financial year so you can utilise the catch-up rules to minimise your tax in that instance. So yes, Leanne, that's right. Jeff asks, is the same rule retrospective? If I have underutilised concessional contributions for the last few years, can I now add more than $35,000 in total for the next couple of years? No, that rule only starts to kick in. It only starts in the 2000. You only start accruing the unused portion of your concessional contribution limit from the 18-19 financial year. So any unused portion of concessional contributions, not utilised in prior financial years, including the 17-18 financial year, are lost. If you don't utilise them, you won't be able to use them in future financial years. Leanne is just following up with, what is the benefit of concessional contributions? If I have already paid income tax on my savings, why would I put money into super? The key answer to that is that for retirement purposes, often it's best to have a cash reserve of 6 to 12 months of living expenses, and then all your other resources in the pension phase of superannuation, because there's no tax on the drawings once you're over 60, there's no tax on the earnings, and it means that there's no tax liability for you, but it can also be no tax on or depending on the components, can be no tax or limited tax for your beneficiaries as well. So it's really all about the tax savings longer term, Leanne. That's why we would put money into that environment. Sophia is saying, are the concessional contributions the pre-tax salary contributions? If so, if I salary sacrifice $1,000, is it correct that I will be taxed on that $1,000 when my salary is processed? Instead, it will be, not taxed on that $1,000 in my salary. Instead, it will be taxed at 15% in my super fund. Exactly, you've hit the nail on the head, Sophia. So what we're saying is that that's the benefit of salary sacrifice, the difference between your marginal tax rate and the 15% contributions tax rate. It's exactly right. William asks, these bring forward rules must be used when under 65, not post 65. Is that right? Yes, that's right. So there's two requirements for the catch-up rules. Or actually, you might need to clarify these concession and contribution catch-ups. There are two requirements. One is that you have a balance in super less than 500,000. And I'll just need to check whether, if you've satisfied the work test, you might be able to utilise the rules over 65 as well. I'd have to check that. So if that's your question, Will, then ask me later, or send me an email, and I'll try and address that for you. Jeff says, what will happen if your salary is such that the compulsory super contributions are more than $25,000? I assume that means that there will be no value in adding salary sacrifice. No, if your income is, if your superannuation guarantee contributions are $25,000, then depending on your contract, you're likely to just get more money paid as a salary to you, taxed at your higher marginal tax rate. That's right. I think I've got through everyone's questions there. Thanks for those. That's good. Now, the next rule that we need to cover off, or next question or decision you need to make, is deciding whether to start, stop, or reboot your pension. So if you've got a Christian pension, you need to decide, or you're eligible to start a Christian pension, you need to decide whether that's worthwhile to either start it, if you've got one, whether you should stop it, or if you've got one, whether you reboot it and combine it with your current superannuation balance. Now, I apologise for those that are not near this your preservation age, because this next section doesn't really apply. But we will be doing a session webinar in the next month or so about issues to do with accumulators rather than those approaching retirement or transitioning to retirement. So I apologise for those that aren't around this age. But the key age at which you can access your super in the form of a pension is your preservation age, and it's based on your date of birth. So if you check out your date of birth, you can work out what your preservation age is, and therefore that is the age at which you can access your superannuation money. For those of you who have a pension accounts higher than $1.6 million, on the 1st of July, you'll need to actually roll back the balance over $1.6 million to the accumulation phase, or withdraw it fully from superannuation. Now, often people think that, well, I'm nowhere near that limit, but some people have what we call defined benefit pensions, and that's where they're often the Commonwealth Super Scheme or the Public Service Super Scheme, where they get a regular income that's indexed up each year, and they're actually being given a capital value under this limit of 16 times the annual amount. So if someone's receiving a defined benefit pension of $60,000, for example, then 16 times that is $960,000. So that $916,000 is added towards the $1.6 million pension superannuation limit. So if that individual has got an account-based pension as well, like a Christian pension, of $700,000, their total balance will be $1.66 million. That's $60,000 over the threshold, and they would either need to roll back to the accumulation phase or withdraw from super altogether $60,000 of that account-based pension, because you can't withdraw any funds from the defined benefit pension. So just to highlight that for those people that do have defined benefit pensions. Or the other change that's occurring is that transition to retirement pensions, so they're pensions that you've started once you've reached preservation age, but you have not satisfied a condition of release. Currently, those pensions are tax-free. They pay no tax on the earnings within the fund. So if you've got $100,000 in your account and it earns $5,000, then it's taxed at 15% or $750. So they're going to change that to be taxed like a normal superannuation accumulation account at 15%. So you need to decide, if you're in this phase, whether you're going to actually retain your pension in that transition to retirement pension. But just to give you a quick summary of how that works, and this is for people that are either in a transition to retirement sort of strategy or considering it, this is how it works. So once you've reached the preservation age that we've talked about earlier, and you might have a a super balance, let's say, of $200,000 in the accumulation phase. That's where you're putting money into super, you're not drawing money out of it. You can leave the minimum balance in your account of $5,000 and then roll over the remaining amount to the pension account. So now you have two accounts. And someone asked, how do you do that? And it's simply completing a form. So you complete a form, get the product disclosure statement, either for, call up and get the physical copy, or you get it from the Christian Super website. Complete the form and you can start a new account, a pension account, and leave a small amount in your existing account so that you can continue to put money into it, your employer contributions into it, and you can roll over the rest to pension phase. Now, accumulation accounts are currently taxed so they both have investment growth, so they've got the same types of investment options. They both should grow in terms of their longer term value. But the accumulation account is taxed at 15%. So if it was a $5,000 account earning 5%, there would be only about $40 in tax on that, because it's a small amount on the $5,000 in the account. Whereas in the pension account currently, there's no tax, regardless of what sort of account it is. But that's going to change from the 1st of July. Transition to retirement pensions are going to be taxed at 15%. So if you've got $195,000 in it and it's earning 5%, there might be $1,400 or $1,500 of additional tax that you'll pay from the 1st of July. So you need to decide, are you going to maintain the pension, or will you roll it back to your accumulation account? Do you roll it back to this account? Now that will largely depend on whether you've satisfied a condition of release or not. So if you've reached a preservation age, you can start a pension. Depending on whether you've satisfied a condition of release or not determines on what type of pension you can commence. So if you're under 60 years of age and you have ceased gainful employment, and you declare at that point in time that you never are going to go back to gainful employment, and gainful employment is working 10 hours a week or more. So if you have satisfied that, you're under 60, you've ceased employment, and you say that you're not going to work more than 10 hours a week into the future, then you've satisfied a condition of release and you can commence what we call an account-based pension. So you could change your transition to retirement pension to a account-based pension, and then the earnings can be tax-free from that point in time. Another condition of release is if you're 60 years of age and you've ceased a form of employment. So you might have two jobs, you've ceased one, you're over 60, and that satisfies a condition of release and achieves the same outcome. So rather than being taxed at 15% from the 1st of July, you'll maintain your tax-free status. And then there's a catch-all at 65 years of age. When you turn 65, it satisfies a condition of release, and again, you can maintain that tax-free status in your pension, your Christian pension. So you need to firstly understand what type of pension you have, or if you've reached a preservation age, what type of pension you could start. So is yours a transition to retirement pension where you've not satisfied a condition of release, or is it an account-based pension where you have satisfied a condition of release? So if you've not satisfied a condition of release from the 1st of July, the earnings within the account are going to be taxed at 15%. And you need to decide whether you maintain that account or whether you roll it back to pension phase, roll it back to the accumulation phase, or leave it as is. Now, the key factor really, from our perspective, is whether you need the cash flow. If you've got a transition to retirement strategy in place and you need the cash flow to maintain the tax savings of the salary sacrifice strategy, then you might keep it in place just because you need the cash flow from it. You can, if you're over 60, you can draw the funds from the account still tax-free, even though the earnings within the account are not tax-free. So if you need the cash flow, you might leave the transition to retirement pension in place. Another reason why you might maintain the transition to retirement pension is that if you've made one of these non-concessional contributions, put say $540,000 into the account and then roll it to pension phase, being in pension phase keeps those tax-free components. So that's one other reason why you would maintain the pension account, even though it's taxed the same, the earnings are taxed the same as an accumulation account. And then finally, you may need to also consider, not if you're a Christian super member, because it's a pooled investments, but if you've got your own super account, or you've got an account where your own specific investments within it, you also need to consider CGT relief as well, because you may be able to clear some of your tax liability within the pension if you're in a fund other than Christian Super. If you're in your self-managed super fund or another type of fund where you own your discrete investments within your account, and you might be able to save some capital gains tax by claiming the CGT relief that is part of that new legislation. So you need to consider whether or not to start, stop, roll back, or reboot your transition to retirement pension. But if you already have an account-based pension, that means you've satisfied a condition of release, you've already receiving zero tax-free earnings, then you can potentially just maintain it if your balance isn't over that $1.6 million threshold. But you might want to consider or not whether you would reboot it or not if you have gone back to work or continued to work. You might not reboot it, because then part of it would be taxable, part of it wouldn't. So just trying to explain that decision as well. The decision to roll back does not really need to occur until closer to the 1st of July, or you can go a bit later than that as well. You can just leave it in place, and your transition to retirement pension will just start to be taxed on it rather than being tax-free. Now, I've spoken for a little while there, so I'll just check if there's any more questions. So Kerry says, thanks, meaning I could use my super as a pension between now and turning age 60. Yes, Kerry. So if you're born in 1959, your preservation age is 55, so you would already have access to your super money in the form of a pension. If you have satisfied a condition of release, you could actually draw lump sums as well from super, but there may be tax implications if you are under 60 years of age. Jeff says, so if the TTR pension will be taxed at the same rate as the accumulation fund, why swap? It depends on whether you're saying why swap to pension phase, as in why start it. The reason you might start it is because there are significant savings available if you salary sacrifice, like we talked about earlier on in the session. But if you haven't got the funds or the cash flow to do it, starting a transition to retirement pension, even though there's no tax benefits on the earning within the fund, might free up the cash flow to get the tax savings on the salary sacrifice side of things. If you're talking about why would you swap back to the accumulation phase, it's really just about simplicity. If you don't need the cash flow, you're going to be taxed the same on an accumulation account as a transition to retirement pension, so you might as well just put it back into the accumulation phase and save the $86 annual account keeping fee. There's not a big issue unless you've got some of those questions around cash flow or trying to maintain those those tax components in the tax-free status. Pieter is asking, does the transition to retirement pension become an account-based pension after you turn 60? No, you have to still satisfy a condition of release. The catch-all is 65 years of age. That's when your your transition to retirement pension would become an account-based pension. Not at 60. You would have to actually ask your super fund to change it to what we call unrestricted non-preserved components, and therefore an account-based pension. If you've turned 60, it's not going to happen automatically. It's only at 65 that it happens automatically. Pierre said, "Oh, sorry, 65. Yep, sorry, I went a bit overboard explaining after you've clarified." Ross says, "Can you DD to your pension account from your accumulation account? Can you direct debit to your pension account from your accumulation account?" I think what you're meaning, can you just transfer funds from your accumulation account to your pension account? That's what happens when you commence the pension, but you can't add to the pension afterwards. So if you want to add to your pension, you've got to start a new pension and roll over the existing pension with some money in another accumulation account in order to do that. You can't add to the pension account without rebooting it or restarting it. You meant add to, yep, no worries. Ross. Ken says, will there be any benefit in TTR strategy in the future for those who have not started one? Yeah, definitely. There's still benefit in the TTR strategy. It's just that it's reduced significantly with the contribution threshold going down to $25,000. It is reducing, but there is still benefit in it. The main benefit is going to be around the salary sacrifice strategy. A minimal benefit, the only benefit of the moving to pension phase will be if you haven't satisfied a condition of release, will be the cash flow side of things. Yeah, so that's the difference. But it does put more emphasis on satisfying a condition of release, which is what the simpler super rules 10 years ago were trying to prevent to a degree. They were trying to free up rules so that people could scale back their work and get access to their super money to enable them to sort of transition slowly out of the workforce rather than having to fully retire to get access to their money. But it does put more emphasis on satisfying a condition of release. So these rules here become more important. If you're under 60, ceasing employment and saying that declaring that you don't intend to become gainfully employed again. The one that you really should look out for is if you've turned 60 and you change jobs. That satisfies a condition of release and can have some significant tax savings. So that's really well worth trying to put in your memory bank there. And people a lot of the time don't realise that they've satisfied the condition, and then also don't take advantage of the tax savings by being in that pension phase of super as well. And then, yeah, turning 65 as well. Yeah, thanks, Ken, for the question. Jeff says, will the conditions of release see an increase from 65? Will the conditions of release see an increase from 65 to an older age sometimes in the future? Yeah, there's potential that it could be moved to equal the age pension age, which is currently moving from 65 to 67 years of age, and proposals to move the age pension age, that's the government age pension, to 70 as well. And there is a bit of a difference at the moment, and if the Centrelink age pension age would increase to 70, there'd be 5 years difference. And yeah, the problem with moving that is that it undermines stability in the superannuation environment, and then people start to pull their money out of super, which has negative impacts for the government longer term. So whether they do that is another thing. Kim says, so at age 65 the account automatically changes from accumulation to pension. No, it doesn't. Good question. This is a common mistake that people who have turned 65 years of age assume that automatically their accumulation account will move to pension phase. It doesn't. You need to actually complete an application form for that to occur, and that's one common mistake that I see over and over again. People have either satisfied a condition of release and not moved to pension phase, so not achieving those tax savings, those 0% tax on earnings, and they mean that they're missing out on that accumulating further funds to support their retirement. So one big mistake, you need to actually complete a form to move to pension phase. Ross asks, as you get closer to retirement, is it better to have funds in a pension account or accumulation account? Depends on if you've satisfied a condition of release. It used to be that a no-brainer because all pension accounts were tax-free, but now it depends on whether you've satisfied a condition of release or not, as to whether it's beneficial being in the pension phase or not. So it's a little more detailed, the question. David says, I have a transition to retirement pension. Each year I have the option to draw between 4 and 10% from the pension. I'm over 60. Will this money be taxed next financial year? No, David. The way that money is taxed when you're drawing from super has not changed. That rule it stays the same. So if you're over 60, all the drawings from super are currently still tax-free. Thanks for your questions. They're the key changes I'll put the recording of this webinar and other related information on this page on my website, but you can also call Christian Super on 1300 360 907. You can call us on 1300 275 428, and there's the Christian Super website as well. I had a range of questions come through on registration of the webinar, and I grouped them into several areas. The key one that came up most consistently was the retirement planning or retirement funding question. So how much do I need to retire? When can I retire? Will I get the age pension? How does my income or assets impact the age pension? If they're your types of questions, then it's really good if you can go to the cornerstonewealth.com.au/retire 2016. On that page, you'll see these videos. So these are previous webinars. They're all generally around an hour or so. You can skip through to the parts that are more relevant to you. You don't have to sit through the whole thing. So you can fast forward, move through them. But what you'll get here is the retirement planning webinar. It's a 2016 webinar, but it talks about all those funding. How much do I need to retire? What are the phases of retirement? What sort of emotions will I feel? And what sort of action should I be taking? The transition to retirement one is really about the transition to retirement strategy. So it'll explain the transition to retirement strategy. We'll update all of these webinars in the second half of the year, so from July through to I think November. We'll be running this whole series again. It's the key content that we get asked for, but it is available from currently on that website. So if they're your questions, it's well worthwhile checking them out. The other one is about reducing capital gains tax and assisting your beneficiaries, maximising your estate to your kids, etc., and then applying for the age pension. But there were a number of you that asked about Centrelink issues. I think a couple of those webinars are on the previous retirement planning webinar, but this one talks about the changes on the 1st of January. So go to cornerstonewealth.com.au/Centrelink 2016, and that'll get you the changes to Centrelink that occurred on the 1st of Jan, but it'll also give you this other video here, the 2015 Centrelink Age Pension webinar, which explains the income and assets test and the interaction between your income and your assets and how much pension you'll get. And then the other one is more detailed strategies about how to maximise your age pension. And then there's another, I think this might be from the Human Services website, about the work bonus, explaining that you can earn up to $6,500 a year and still and it not impact your age pension as well. So check out those resources. One other group of you asked consistently about insurances. One of you asked about how do I claim? I've been off work due to illness for a time. How do I claim? Just call Christian Super on 1300 360 907 to get that started. But if you've got more general, a number of you just had general Christian Super questions, insurance questions. I set up a page a while ago about titled cornerstonewealth.com.au/CS insurance. It explains insurance and the 3 steps that you need to go through to work out what types of cover there are, and then work out how much you need, and then how you go about applying for the cover as well. There's 2 parts of that. One is that a number of you are asking, well, how do I reduce my fees? How do I make sure that my super balance isn't going down? One thing is to ensure that you have the right insurance cover. So you're not taking out more cover than you need and paying more fees than you really need. Fees in terms of insurance premiums, because they are a drain on your super balance. So setting those at the right thresholds are important. Just one other question that came up consistently was when you can access your super. We talked about this before. So based on your preservation age, this is based on your date of birth, you have a preservation age, and it's when you've reached your preservation age that you can access your super in A form. Depending on whether you've satisfied a condition of release, it determines on what form you can access your super in. So if you have satisfied a condition of release, then you've reached your preservation age and retired or turned 65 years of age, then you can access your super in the form of a lump sum, so take out large lump sums, but there are some tax implications if you're under 60. You can take out up to $195,000 as a lifetime limit from your super under 60 years of age and not pay any tax. But if you're over 60, drawings from super are fully tax-free. But if you haven't satisfied a condition of release, you can start what we call those non-commutable account-based pensions, or what we call the transition to retirement pension. And then you are required to draw a minimum amount, so this 4% amount, but you're limited to a maximum amount of 10% a year. So if you're between 55 and 64 years of age and you've reached your preservation age but not satisfied a condition of release, you can draw 4% from your super account and up to 10%, but no more than 10%. If you've reached your preservation age and met a condition of release, then you can start an account-based pension, and there's no limit to what you can draw from the fund. You just need to be wary if you're under 60 that there are some tax implications. So I hope that answers a number of you that asked about getting access to your super money. I'll just quickly check if there's any other questions that have come through. Grant asks, I had heard that after the July 1st, there would be a restriction to the removal of bulk amounts from super accounts. Is this correct? No, there's no changes to the withdrawal of funds from super. It's all about restrictions to the contributions to super and also to the amount that you roll over to pension phase as well. So there's not the restrictions on withdrawing. There's no changes in that respect. It's all about how much you can get in. So as they're tightening up, it's worth considering how much you do want to pull out of super. Kim asks, post age 65, if you are still working, can you maintain both accumulation and pension accounts? Yes, you can maintain both. There's no problem at all. You can maintain both throughout your lifetime. You can roll between the two. The difference moving forward is that rolling backwards and forwards between accumulation phase and pension phase has an impact on what we call the transfer limit, so pension transfer limit. It's this new rule that you can only have $1.6 million in super. So when you're transferring backwards and forwards between pension phase, it adds and subtracts from that limit. So if you are getting closer to those $1.6 million limits, you really need to think through how you actually transfer between accumulation phase and pension phase. William says, so I can cash out my super at 65 and put in my younger spouse's super. Does that mean she will pay more tax on it than I would in pension phase? Good question. Well, it depends on whether your spouse has satisfied a condition of release or not. So that is a strategy that we commonly implement, where we hold superannuation in the lower income earner's name so that we can access the full age pension for the not the lower income earner's name, the lower age spouse's name, who has not reached their age pension age yet, so that we can get the full age pension for the older spouse who is of age pension age. But it depends on whether the younger spouse has satisfied a condition of release or not as to whether the account is taxed or not. Although for that particular strategy, you need to hold the superannuation in the accumulation phase anyway. So it would be taxed at the 15% rate, because to make that strategy work, you actually have to have it in the accumulation phase, which is taxed at 15%. And Liz says, thanks for the info. Pleasure, Liz. Thanks for joining us again. So there's no further questions coming through at the moment. I did have one question about the spouse contribution and the threshold. So this financial year, we are still under the old spouse contribution threshold of $10,800. So this is a strategy where if you have a spouse who earns less than $10,800, or it actually scales back between $10,800 and $13,800, but you get full access to this benefit if your spouse's income is less than $10,800. Next financial year, that threshold is going to increase to $37,000. So well worth considering next financial year if your spouse earns under $37,000 and you pay tax yourself. How it works is that you receive a $540 rebate if you put $3,000 into your spouse's account as a spouse contribution. This financial year, the threshold for your spouse, the taxable income for your spouse, or total income for your spouse, sorry, needs to be less than $10,800. Scales back between $10,800 and $13,800, so your rebate would scale back. But next financial year, from the 1st of July 2017, $37,000 is the threshold. So what's it worth? $540 tax back if you're fully eligible, or you and your spouse are fully eligible. How do you get it? You put $3,000 into your spouse's super as a spouse contribution. Now you need to make sure that when it goes into your spouse's super account that it is defined as a spouse contribution. You can do that with Christian Super by completing a member contribution form that's available, I think, from the website. And then what's the criteria? Well, the criteria this financial year is $10,800 of assessable income. Next financial year, it's going to be $37,000. So it'll be more people will be eligible for it and worthwhile considering. And that's covered off all of the questions for this evening's session. Egan, can super be lost if global economy crashes? Yeah, I think, Egan, you might have asked this one on the way in on registration. If you look at the global financial crisis, people often say that, I lost all of my super during the global financial crisis. But if you look at the 10-year returns on super, which include the global financial crisis, the returns on the highest risk option within Christian Super still return about 5% over that 10-year period. So somebody who was in the highest risk option before the global financial crisis but kept their money in it and potentially continued to contribute to it would have actually returned at least a 5%, even including the global financial crisis. So can you lose all of your super? Very, very, very unlikely. For that to happen, the whole value of your super account, the whole value of a super account would need to go to zero. For the whole value of your super account to go to zero, you would need to see all the value of the shares that are on the Australian share market go to zero. So all the banks totally collapse, all your mining companies totally collapse and are worth nothing. For that to happen, everybody would be unemployed. It is not a scenario that is likely to ever happen. What could happen is something equivalent to the global financial crisis, where we'll see a halving of the share market. So during the global financial crisis, the share market went from 6,800 points down to about 3,300 points. And so that was more than a halving of the Australian share market. And so during that time, portfolios did go down in value, but if you didn't sell out of them and you retained your investments, then you would have seen them both get dividends and other unit price increases to the tune of still maintaining a 5% return over that period of time. So is it possible? For it to be possible that you would lose all of your super money, the whole share market would need to go down to zero, which just wouldn't happen. Hopefully that answers your question. One thing we do though, we particularly those that are in the transition phase of superannuation, is that we regularly try and factor in creating a buffer from a global financial crisis again. And the way that we do that is we hold enough liquidity in our superannuation account so that we don't need to touch our investments in low market. So if that's something that you're thinking about, if you go to cornerstonewealth.com.au/buffer, BUFFER, you'll get this video which explains that in a bit of detail. so it if I just can pull up the chart here. Sorry about those suggested videos there. The pension, so if you've got a pension account, you could have it fully in the balanced option, or which is 50% in equity, 50% in bonds. So that's like fixed interest and term deposits, and this is like shares and property, etc. But if you bought units within your pension account at $10, and then the super account, so then the share market went down, the unit price might be then $7, which is kind of like what happened during the global financial crisis. If you sold out at this point in time, you would have locked in your losses. But if you waited a little bit longer to see your the share market return in value, you will have seen the unit price go back up again, and you would have made your losses back. But in the meantime, if you're having to draw your pension from it, then you would have had to sell out at these low points. So what we do is hold a portion of your investment in cash and draw the pension from that option. And we say a minimum of, say, 10%, which is generally 2 years of pension payments. But if you're more conservative, you might have up to 5 years of pension payments, or 25% of your fund in cash, just to give you a buffer from those types of global financial crisis periods where there's negative returns. I hope that answers your questions. It's probably taken a bit longer than what most of you needed or wanted, but hopefully that's helped. I'll just come back to everyone else's questions. Andrew says, thank you, pleasure. Vivian saying, thank you, pleasure. Jim saying, thank you. Craig saying, thanks. And g'day. Thanks, Craig. Thanks, Gavin. From Jeff. One more question. Okay, Jeff, if we want to make concessional contribution, which will take me over the $25,000 limit from July 2017, will any contribution which takes me over this limit be taxed at 30% or the highest marginal tax bracket? Yeah, good question, Jeff. What happens is that they've made the excess contribution rules a little bit more reasonable. Previously, you would be either taxed at the top marginal tax rate, or if you breach both limits, you could be taxed at sort of 96%. So they've made them a lot more reasonable. And so how it works is that if you've gone over your $25,000 contribution limit, and to just be aware that the limit is based on what's actually hit your account. So you need to understand what's hit your account, because sometimes there's contributions that relate to June that hit the account in July, and that's what often causes an issue of a breach in the limit, that 1 year's payments have gone into the next year's superannuation account, or gone into the superannuation account the next year. So you need to be aware that it's relating to what goes into the account, not what your pay slip says. But if you go over your $25,000 threshold next financial year, how it works is that you the amount over the $25,000 is effectively taxed at your marginal tax rate, and then on top of that, you're charged a penalty interest rate for the year up until you submit your tax return. And I think it's about 6% at the moment. So 6% for at least a year. But if you don't, even if you just put the contribution in June and you submit your tax return in July, you'll at least pay 13 months of that penalty at 6% of the amount over the contribution. But it's not a massive amount, like at 6% of $1,000, for example. But it's still, so it's not a big deal if you go over those thresholds, because the penalties aren't significant, but you wouldn't want to aim to go over those thresholds, because you just end up paying a penalty for that over and above what you would pay for your marginal tax rates. Ruth asks, I work as a contractor, not employee. Is what you have covered tonight only apply to an employee? No, it actually just gives you as a contractor more flexibility to get funds in. You don't have to salary sacrifice the funds. You can work under what we call deductible super contributions. So if you're self-employed, your employer's not putting contributions into your into your super account on your behalf, so it's your responsibility, and you can then choose to make those at the amount you see fit. To satisfy that requirement, you have to earn no more than 10% of your income from employment purposes. So if you're self-employed, you're getting no employment income, it's all contract income, and therefore you satisfy that rule and can make a contribution to super and claim a deduction on it. So you just need to submit a form to do that. So you put the contribution in and then you claim a deduction. You can do it after the end of the financial year if you want to, if you want to work out how much to claim of your contribution, but you probably know based on your cash flow and your tax situation that how much you could claim. Hope that helps, Ruth. Graham asks, if I need to roll over my pension to a new pension after July 2017 so as to withdraw some funds, how does 1.6 million limit apply if this happens several times? What happens there is that there's a what's the best way to explain it? There's a transfer balance. So if you commence a pension, so the question is, how does this work going to and fro between the pension limits? So if you need to roll over to a new pension, how does it work? So if you've got, let's say, an accumulation account here that's got $500,000 in it, how the transfer limit works is that if you then roll that over to pension phase, so the whole balance, close that account, open a pension account that's got that full amount in it, that $500,000, then you've got an account with the ATO effectively that says, I've now utilised 500 of my $1.6 million transfer limit. So you've then got another $1.1 million left of your transfer limit, based on that. So, but then if you've got this pension account and then you've developed another accumulation account with another $500, it depends on what the value of this account is so say that's another accumulation account, and then you want to combine those two accounts into a new pension account, then the way the transfer balance works is that if you've just taken regular minimum pension payments from this account, it depends on what the balance of this account is as to how it will affect your transfer limit. But how it would work is that by moving to a new pension account, what effectively happens, even though from a paperwork perspective, you might be actually going from here to here to get a $1 million account over here. Officially what happens is you're going into this accumulation account first, so the 500 gets put into the accumulation account. But let's say that this account here has gone down by, perhaps there was bad performance, and so we've got negative returns, and after your drawings the balance is now only $400,000. And now that means that when you roll this $400,000 to your accumulation account, that means you'll get a credit over here of 0.4 million, which means that your total contribution or transfer balance is now 1.5 million. So you've kind of lost $100,000 of your transfer balance, your pension transfer balance. Bit of a complex thing, and we'll slowly be able to explain this a little bit more clearly as over time, but that's how it works at the moment. So then when you roll over your $900,000 here to your pension account, you then have not $1 million here, it's going to be $900,000 over here, and you will have used up 900 of your limit, so 0.9 mil you would have transferred over, and so therefore if you're taking 0.9 across here, you've then got a transfer balance of $600,000 at that point in time. So it's kind of a debit and credit sort of scenario. The opposite can work as well though. So it is actually advantageous if you, if rather than being $400,000, it goes up to $600,000. It means that you you get a negative balance, which can actually help you because you can then utilize that balance. So the opposite can occur. Your $500,000 becomes $600,000. When you roll it back to the pension account, that $600,000 then adds to 6 over here, which gets you to 0.7. And so then you've got a transfer balance of 0.7. And then if you then, just gives you an additional amount that you can get across, which is higher than 1.6. But then if you roll it across again to accumulation, to a pension phase again, it's 1.7. Take the 1.1, and you get back to the 1.6. Bit complex, but that's how the strategy works, or how the transfer limits work. I'll just go back to your question. So that was Graham, I think. Grant says, thanks, pleasure. Helpful. Craig says, yes, helpful. Thanks, Gavin. Pleasure, Craig. Will says, thanks. Everyone just saying thanks. Appreciate that. Appreciate the positive feedback. And Philip's in Kalgoorlie. That's I think you would have won the furthest Australian-based attendee, so well done. Will says, if I haven't put in $25,000 concessional contribution this year, does that mean I can put in $25,000 after 1st of July without being breached? No, that catch-up rule doesn't start until the 2018-19 financial year, so it's a fair way off. Craig says, so to ask the obvious, the new 25k annual contribution limit before the additional taxes kick in, so the new 25k annual contribution limit before the additional taxes kick in includes both superannuation guarantee and salary sacrifice contributions. Yes, it does. Exactly right, Craig. So they're called concessional contributions, and they're made up of superannuation guarantee, which is your employer contributions, salary sacrifice, any additional employer contributions, and personal deductible super contributions. So it includes all those things. Graham says, thanks to understand, very helpful. Pleasure, Graham. Glad that it was a bit of a messy explanation, but I'm glad that you picked it up. That's good. So it looks like there's no more questions. Thanks again. Really appreciate you attending, and we'll send through some further resources later on. Good night.